Welcome to this presentation on the foundational principles and core due diligence in the context of financial crime in the UK. Today, we'll be exploring key aspects of financial crime, the UK's commitment to anti-money laundering, AML, and counter-terrorist financing, CTF, and the essential legislation and regulations that govern these efforts. Understanding financial crime. Let's start by understanding what financial crime entails. Financial crime includes activities such as money laundering, terrorist financing, bribery, corruption, fraud, and cybercrime. These crimes have significant socio-economic impacts, affecting individuals, businesses, and society as a whole. Money laundering. Money laundering is the process of making illegally gained money appear legal. It involves three stages: placement, layering, and integration. For example, a drug dealer deposits small amounts of cash into various bank accounts, placement, then transfers the money to multiple accounts and countries to obscure its origin, layering, and finally uses the funds to purchase a luxury car, integration. Terrorist financing. Terrorist financing involves providing funds for terrorist activities. Unlike money laundering, the source of funds can be both legal and illegal. For example, a legitimate charity collects donations, but a portion of the funds is secretly diverted to finance terrorist activities. Predicate offences. Predicate offences are crimes that generate the proceeds that are laundered. These include bribery, corruption, fraud, and cybercrime. For example, a company executive accepts bribes to award contracts to certain suppliers, leading to inflated prices and reduced competition. The socio-economic impact of financial crime. Financial crime can lead to loss of investor confidence, increased costs for businesses, and reduced public trust in financial institutions. The UK's commitment to AML-CTF. The UK is committed to combating financial crime through robust AML and CTF measures. Banks play a critical role as gatekeepers, ensuring that illicit funds do not enter the financial system. For example, banks are responsible for detecting and reporting suspicious transactions, preventing illicit funds from entering the financial system. Non-compliance can lead to reputational, regulatory, and criminal consequences. A bank that fails to comply with AML regulations may face hefty fines, legal action, and damage to its reputation. Risk-based approach, RBA. The risk-based approach, RBA, is essential for effective AML-CTF. It involves assessing and managing risks based on the specific circumstances of each case. For example, a bank assesses the risk level of a new customer based on factors such as occupation, country of residence, and transaction patterns, and applies appropriate due diligence measures. This approach ensures that resources are allocated efficiently to mitigate the highest risks. Key UK legislation and regulations. Several key pieces of legislation govern AML-CTF efforts in the UK. Proceeds of Crime Act 2002, POCR. This act outlines offences related to money laundering, suspicious activity reports, SARS, and asset recovery. For example, POCR allows law enforcement to confiscate assets obtained through criminal activities, such as luxury cars and properties. Terrorism Act 2000, TACT. This act includes provisions related to terrorist financing. For example, TACT includes provisions for freezing assets suspected of being used to finance terrorism. Money laundering, terrorist financing and transfer of funds, information on the pair, Regulations 2017, MLRs 2017. These regulations set out core obligations for regulated firms. For example, MLRs 2017 require firms to conduct customer due diligence and report suspicious activities. Sanctions and Anti-Money Laundering Act 2018, SAMLA. This act establishes the UK's sanctions framework. For example, SAMLA allows the UK to impose sanctions on individuals and entities involved in money laundering and terrorist financing. FCA Handbook and JMLSG Guidance. These resources provide practical compliance guidance for firms. For example, the FCA Handbook provides detailed guidelines on AML compliance, while JMLSG guidance offers practical advice for firms. Customer Due Diligence, CDD. Customer Due Diligence, CDD, is the foundation of AML-CTF efforts. It involves identifying, verifying, understanding, and assessing the risk of customers. CDD is required for new relationships, occasional transactions, and when there is suspicion or doubt. For example, CDD is required when a bank opens a new account for a customer, conducts a large one-time transaction, or suspects money laundering. Identifying and verifying individuals. For individuals, CDD involves collecting information such as name, date of birth, address, and nationality. Reliable sources for identity verification include documents and electronic methods. For example, a bank collects the customer's name, date of birth, address, and nationality to verify their identity. Verification of address and non-face-to-face onboarding challenges are also important considerations. For example, a bank verifies the customer's address by checking utility bills or rental agreements. Identifying and verifying corporate clients. For corporate clients, CDD involves collecting company information such as name, registration, address, and legal form. Proof of existence and legal standing, as well as understanding the ownership and control structure, are crucial. For example, a bank collects the company's name, registration number, address, and legal form to verify its identity. Simplified Due Diligence, SDD. Simplified Due Diligence, SDD, is a streamlined approach for low-risk scenarios. It can be applied to certain customer types, product types, and other low-risk situations. For example, SDD is applied to low-risk customers, such as government entities and publicly traded companies. However, minimal checks are still required, and misapplication of SDD can become a compliance vulnerability. For example, misapplying SDD to high-risk customers can lead to money laundering and regulatory penalties. Enhanced Due Diligence, EDD. Enhanced Due Diligence, EDD, involves intensified scrutiny for high-risk customers. Mandatory EDD scenarios include high-risk third countries, politically exposed persons, PEPs, non-face-to-face relationships, unusual or complex transactions, and suspicion of money laundering or terrorist financing. For example, EDD is required for customers from countries on the FATF blacklist. Key elements of EDD include deeper identity verification, in-depth source of funds and source of wealth verification, enhanced background checks, rationale for the business relationship, and senior management approval requirements. For example, EDD involves verifying the customer's identity through multiple sources and methods. Risk Assessment Framework. The Enterprise-Wide Risk Assessment, EWRA, is crucial for understanding and managing risks. It involves assessing customer, product, geographic, and delivery channel risks. For example, EWRA involves assessing risks related to customers, products, geographic locations, and delivery channels. EWRA informs customer risk ratings, which can be inherent or residual. Developing robust risk rating methodologies and understanding factors influencing customer risk are essential. For example, factors such as the customer's occupation, industry, geographic links, and complexity of their business structure influence their risk level. Ongoing monitoring and reviews. Ongoing monitoring is vital for detecting suspicious activity and maintaining accurate customer profiles. Transaction monitoring systems, PEP, and sanction screening updates, adverse media monitoring, and periodic reviews are key components of ongoing monitoring. For example, ongoing monitoring helps banks detect suspicious activity and maintain accurate customer profiles. Policies, processes, and procedures. Clear, comprehensive, and up-to-date policies and procedures are essential for effective AML-CTF efforts. Record-keeping requirements, ongoing training and awareness, internal controls, and independent audits are important aspects of compliance. For example, banks develop clear and comprehensive policies and procedures to guide their AML efforts. Reporting, international landscape and enforcement. Suspicious activity reporting, SARS, is the gateway for intelligence to law enforcement. Recognizing red flags, understanding the internal and external reporting process, and avoiding tipping off are crucial. For example, red flags include large cash deposits, unusual transaction patterns, and rapid movements of funds between accounts. International standards and bodies, such as the United Nations and Financial Action Task Force, FATF, play a significant role in global AML-CTF efforts. For example, FATF sets global standards for AML and CTF efforts. Emerging trends and future challenges. New technologies, such as crypto assets, fintech, and AI, present both opportunities and risks for AML-CTF. Evolving typologies, such as trade-based money laundering and environmental crime, require ongoing vigilance. For example, crypto assets such as Bitcoin can be used for money laundering due to their anonymity. Balancing data protection, GDPR, and AML compliance, as well as maintaining professional ethics and personal accountability, are future challenges. In conclusion, understanding financial crime, the UK's commitment to AML-CTF, and key legislation and regulations are essential for effective compliance. Customer due diligence, risk assessment, ongoing monitoring, and clear policies and procedures are the foundation of AML-CTF efforts. By staying informed and vigilant, we can contribute to a safer and more secure financial system. Thank you for your attention, and I hope you found this presentation informative.